the single greatest stock picker in modern history, a man who turned $10,000 into billions through individual stock selection, has spent decades publicly telling everyone else to do the exact opposite of what made him rich. That man is Warren Buffett, and today we're breaking down exactly why. Here's the contradiction that confuses almost everyone. Buffett built Berkshire Hathaway by picking individual winning companies for over 60 years. Yet, in his own shareholder letters, in interviews, even in his will, he consistently recommends that regular people do the opposite, skip stock picking entirely, and just buy a simple, low-cost index fund. Here's proof this isn't just talk. Buffett has publicly stated the exact instructions in his will for the trustee, managing his wife's inheritance: 90% into a Vanguard S&P 500 index fund, 10% into short-term government bonds, not Berkshire stock, not his favorite hand-picked companies, a simple index fund. By the end of this video, you'll understand exactly why Buffett gives this advice, the result of his famous million-dollar bet against Wall Street, why even professional fund managers struggle to beat a simple index, and precisely how to apply this same strategy to your own money starting today. Here's the core idea I want you to sit with for the rest of this video. If the single most successful investor of the past century is telling you not to try to become him, that advice deserves your full attention, not your skepticism. In his 2013 shareholder letter, Buffett wrote directly, quote, "The goal of the non-professional should not be to pick winners. Rather, he should own a cross-section of businesses that in aggregate are bound to do well. An S&P 500 index fund does exactly that in a single purchase." Even further back, in 1993, Buffett wrote, "By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals." He calls it know-nothing investing, not as an insult, but because it requires zero stock-picking skill to succeed. In 2002, he made the point even simpler: the people who buy those index funds, on average, will get better results than the people that buy funds that have higher costs attached to them, because it is just a matter of math, not opinion, not strategy. Math. At the 2017 Berkshire annual meeting, discussing his wife's inheritance, Buffett explained his reasoning perfectly. The object is not to maximize. The important thing is that she never worries about money the rest of her life. Peace of mind, not maximum returns, was the actual goal. Buffett tells a story to illustrate this. If in 1942, the year he bought his very first stock, you had instead put $10,000 into a simple index fund and reinvested the dividends, never touching it, never worrying about headlines, that $10,000 would be worth approximately $51 million today. The deeper lesson isn't just the dollar figure. It's that you didn't need to correctly predict a single one of those historical events. You just needed to believe that America and American businesses would continue moving forward over the long run and stay invested through all of it. So why doesn't Buffett just recommend everyone do what he does? Because what he does is a full-time professional operation, decades of experience, teams of analysts, deep access to company information most people will never have. The average person simply doesn't have those resources, and honestly, doesn't need them. Buffett actually used a farming analogy to describe this. He said buying an index fund is like buying a farm and letting a tenant farmer work it for you. You don't need to plow the fields yourself or worry about the weather every single day. You just own the farm and let American business do the work. Successfully picking individual stocks over the long run requires years of financial analysis experience, deep knowledge across multiple industries, serious emotional discipline during market volatility, and an enormous time commitment most working people simply don't have available to give. Even Buffett himself has openly admitted to making significant investment mistakes over his career, buying into companies that later struggled or failed. If the greatest stock picker alive still gets it wrong sometimes, the odds for an average part-time investor picking winning stocks consistently are genuinely difficult. The mathematical core of this advice is diversification. If you pick 5 to 10 individual stocks and even 1 or 2 perform badly, your entire portfolio suffers significantly. If you own all 500 companies in the S&P 500 simultaneously, no single company's failure can meaningfully hurt your overall results. Buffett has repeatedly pointed to fees as one of the biggest hidden killers of investment returns. On the exact same $100,000 investment over 30 years, the difference between a 0.03% index fund fee and a 1.5% actively managed fund fee can cost you over $500,000 in lost growth. That's not performance, that's just fee drag. Actively managed funds charge more because they have real overhead, research teams, trading costs, marketing budgets, and management salaries, all of which come out of your returns before you see a single dollar. An index fund has almost none of these costs because there's no team trying to beat the market. It just holds it. Quick recap. Buffett's own will directs 90% of his wife's inheritance into an index fund. He calls index investing know-nothing investing. That beats most professionals. Diversification protects against any single company's failure, and low fees compound into massive long-term differences. Now, let's talk about the bet that proved all of this. Now let's talk about the moment Buffett actually put his money where his mouth was. A decade-long, $1 million public bet against the entire hedge fund industry. In 2007, Buffett proposed a public bet. He would put his money on a simple Vanguard S&P 500 index fund. His opponent, an investment firm called Protégé Partners, chose 5 professionally managed hedge funds of funds. The stakes, $1 million, going to charity over a 10-year period from 2008 to 2017. This was considered a fair test at the time. Hedge funds of funds represented the best of professional Wall Street management, sophisticated strategies, access to top talent, and the ability to short markets or hedge against downturns. If professional management was truly worth its high fees, this should have been an easy win for them. In year 1, 2008, during the height of the financial crisis, the hedge funds actually got off to a fast start. Their hedging strategies cushioned the crash better than the fully exposed index fund. It looked, for a brief moment, like the professionals might prove their worth. But then, in Buffett's own words, quote, "The roof fell in every one of the 9 years that followed. The funds of funds as a whole trailed the index fund. 9 consecutive years of underperformance after that single early lead completely evaporated. The final result, after the full 10 years, the simple S&P 500 index fund returned approximately 125.8%. The professionally managed hedge funds of funds returned just 36.3%. That's not a close race. That's a complete rout from the supposedly smart money side of Wall Street. Why did the professionals lose so badly? Layered fees. The funds of funds charged their own management fee on top of fees charged by the 200-plus individual fund managers underneath them, on top of performance fees. Buffett noted these enormous fees were paid to managers regardless of whether they actually delivered good results. Buffett summarized it perfectly, noting the stark contrast with the very low fees on index funds. He pointed out that, despite strong overall market growth during those 10 years, the hedge fund investors experienced what he called a lost decade, purely because of the enormous fees eating into their returns. This bet wasn't an isolated fluke. Broader academic studies confirmed the same pattern across the entire industry. Over any 15-year period, approximately 90% of actively managed funds fail to beat the S&P 500. The bet simply proved in real time what the data had already been showing for decades. As for the money, the original stake, invested and grown over the decade, ultimately resulted in a donation of approximately $2.2 million to Girls Incorporated of Omaha, a charity Buffett's late first wife had supported. Even the resolution of this bet reflected long-term thinking. To their credit, protege partners handled the loss with professionalism, publicly acknowledging the result and what it meant for the broader active management industry. This wasn't spin or excuses, it was a real, transparent, decade-long test that had a clear, undeniable winner. This lesson isn't limited to exotic hedge funds most people will never touch. It applies directly to the actively managed mutual funds that many regular Americans unknowingly hold inside their 401k plans, often paying 0.5 to 1.5% in fees for the same statistically likely underperformance. Here's a practical action item. Log into your own 401k or investment account right now and check the expense ratios on your funds. If you're paying significantly more than 0.1% for an actively managed fund, it's worth comparing its actual historical performance against a simple S&P 500 index alternative. To be fair, a small number of active managers do consistently outperform over long periods. Buffett himself is proof this is possible. The real challenge is that identifying which manager will be in that rare successful group in advance before they've proven it is extraordinarily difficult, even for sophisticated professional allocators. There's also something called survivorship bias at play. We only hear success stories about the active managers who happen to beat the market, while thousands of underperforming funds quietly close down and disappear from historical records entirely, never counted in the final statistics. In a CNBC interview, Buffett gave his simplest, clearest advice yet. Quote, "Consistently buy an S&P 500 low-cost index fund. I think it's the thing that makes the most sense, practically all of the time, not sometimes, not under certain conditions, practically all of the time." Quick recap. Buffett's famous bet pitted a simple index fund against professionally managed hedge funds. The index fund won by a massive margin, 125.8% versus just 36.3%. Layered fees destroyed the hedge fund returns, and this mirrors the broader pattern of 90% of active funds failing to beat the index over time. So what about buying Berkshire Hathaway stock itself, since it has genuinely outperformed the index over Buffett's career? That's a fair question, but it required his unique 60-plus years of skill, discipline, and access. It's the exception that proves the rule, not a repeatable strategy for the average investor. Buffett has also been honest that Berkshire's massive size now works against outsized future returns, a concept he's described as size being the enemy of performance. It's genuinely harder to move the needle on hundreds of billions of dollars than it is on a smaller amount, which is exactly why he keeps pointing regular investors towards the index instead. Your action plan, straight from Buffett's own playbook. Step 1. Open a brokerage account with Fidelity, Vanguard, or Schwab. Step 2. Search the ticker VOO, or IVV. Step 3. Set up automatic monthly contributions. Step 4. Ignore the headlines and stay invested for decades. This is genuinely the entire strategy. This week's specific action. Check the expense ratio fees on every single fund you currently own, whether in a 401k, IRA, or brokerage account. Buffett's entire lesson today comes down to this one number. Knowing it puts you ahead of most investors instantly. Here's the perspective I want you to leave with. The greatest investor of the past century is literally telling you to be boring on purpose. Not because boring is a compromise, but because boring, low cost, diversified, and patient consistently beats exciting, expensive, and clever over the long run. You don't need to become the next Warren Buffett to build genuine wealth. You just need to follow the advice the actual Warren Buffett gives to everyone who isn't him. That's a strategy anyone watching this can start using today. Thank you for taking the time to really understand the reasoning behind one of the most repeated pieces of investing advice in history. Understanding why makes it far easier to actually stick with it. If this video gave you genuine clarity on why index funds work, hit like and subscribe. I break down exactly how money and investing actually work every single week, completely free. Coming up next, a deep dive into the 2008 financial crisis, what actually caused it, and how it connects directly to everything we just discussed about risk and diversification. You won't want to miss it. Bonus fact to close things out. Buffett has pledged to give away over 99% of his fortune to charity, much of it structured to flow gradually through foundations. Even his philanthropic planning reflects the same patient, long-term thinking as his investment advice. A few more quick facts about the man himself. Buffett bought his first stock at just 11 years old. Berkshire Hathaway's Class A stock has never split, making each share worth hundreds of thousands of dollars. His annual salary at Berkshire has remained just $100,000 for decades, and he still lives in the same Omaha house he purchased back in 1958. There is a clear thread connecting his personal life choices to his investment philosophy: patience, consistency, and avoiding unnecessary complexity or excess. The same mindset that keeps him in a modest house is the same mindset behind recommending a simple, low-cost index fund. The financial industry often profits when investing feels complicated, exciting, and requires expert help. Buffett's advice proves the opposite is usually true for regular people. Simplicity and patience aren't a lesser strategy, they're often the winning one. The most common comment I expect: but what if I want to try picking stocks anyway? That's completely fine. Even Buffett himself has said combining both approaches can work if you're willing to do real research. Just keep your index fund as the core foundation and treat individual stock picking as a smaller, optional addition. The real takeaway from today isn't really about Warren Buffett at all. It's this: the best financial advice often sounds too simple to be worth following, but simple and effective are not opposites. Sometimes they're exactly the same thing. Today's entire video in 3 sentences. 1. Buffett's own will directs 90% of his wife's inheritance into an S&P 500 index fund. 2. His million-dollar bet proved index funds beat professionally managed hedge funds by a landslide. 3. Low fees and broad diversification are why this simple strategy consistently wins over the long term. Remember this: you don't need to be a genius investor to build real wealth. You just need to be consistent, patient, and willing to let a simple strategy work over decades. That's the whole secret, straight from the source. Quick question for the community: do you currently own an index fund? Or are you still picking individual stocks? Drop it in the comments. I read every single one, and I'll reply to the most interesting responses. Final recap. 1. Buffett recommends index funds for almost everyone but himself. 2. His million-dollar bet showed index funds beating hedge funds 125.8% to 36.3%. 3. Layered fees are the silent killer of returns. 4. Diversification protects against any single failure. 5. Simplicity and patience beat complexity over the long term. One final thought before you go: the greatest investor who has ever lived didn't hide this advice in some secret vault. He said it publicly, repeatedly, for decades. The only thing left is for you to actually use it. 5 rapid-fire reasons to trust this advice. 1. He put his own family's money behind it. 2. He proved it publicly with a $1 million bet. 3. Academic data confirms it again and again. 4. Even large institutions increasingly agree. 5. It costs almost nothing to actually follow. The deepest lesson from today isn't really about stock picking versus index funds at all. It's this: trying to be clever often costs you more than trusting a simple, proven path. Warren Buffett learned that lesson across 6 decades. You get to learn it in 20 minutes. I'm Jax, and I'll see you next week for the 2008 financial crisis explained. Until then, take Buffett's advice seriously. He's earned the right to be listened to.